Quarterly earnings reports. Love them or hate them, they have ruled Wall Street for 50 years. But President Donald Trump just called for a revolution, cutting reporting requirements down to every 6 months. And believe it or not, the research says he's right. This could unleash billions in savings, free CEOs from Wall Street's shackles of short-term focus, and help America finally compete with China's long-term vision. Today, I'm going to share with you why this could be one of the smartest reforms in decades. Now, right now, every public company in America must file earnings every 90 days. That's 4 times a year. Endless paperwork, audits, and calls with analysts. So Trump's idea? Cut it in half. Just 2 reports per year. He says it'll save money and let companies focus on running their businesses instead of obsessing over the next quarter's numbers. And the evidence is clear. Quarterly reporting comes with some serious downsides. Here's what the data shows. Smaller companies are getting crushed. As a percentage of revenue, they pay 6 times more than larger firms on audit fees. One study found that when firms switched to semiannual reporting, those expenses fell by 20%. That's money that could be redirected into hiring and research and expansion instead of feeding the compliance machine. But the real benefits will come in the form of innovation. UCLA research found that firms pressured to hit quarterly numbers actually cut corners, even leading to higher rates of workplace injuries. Imagine how much more productive and innovative American companies could be if CEOs weren't terrified of missing earnings by a couple of pennies. But this isn't just about saving money, it is about mindset. Now, Trump pointed to China, and he's right. Chinese firms, especially those state-backed giants, think in decades. They build with 20, 50, even 100-year horizons. Meanwhile, American companies often can't see past 3 months. Now, one notable exception to this here in the U.S. is Warren Buffett's Berkshire Hathaway. Buffett doesn't sweat over the next 3 months. He never has. He invests for the next 30 years. As he famously said, quote, "Our favorite holding period is forever," and his results are a reflection of that. Berkshire Hathaway is one of the most successful investments of all time. The stock has achieved a total return of, and I can't believe I'm saying this, 5.5 million%. Had you invested $1,000 when Buffett took control, it would be worth $27 million today. By shifting to semi-annual reporting, we signal a cultural reset. CEOs can prioritize long-term investments, R&D, and strategy without being punished for short-term fluctuations. That is how you build the next Apple or Tesla or SpaceX. American companies didn't always operate this way. Up until 1970, quarterly reports were not required. You see, following the 1929 stock market crash, Congress passed the Securities Exchange Act of 1934. This was done to increase transparency of financial markets. It required all publicly listed companies to provide financial results twice a year. Then came the recession of the 1960s. This exposed how some companies were masking poor financial performance. Investors demanded more frequent updates, and in 1970, the SEC gave it to them. They mandated quarterly reporting. They introduced Form 10-Q, which has been the standardized form for filing quarterly earnings ever since. A shift back to semi-annual reports would not be unique on the international stage, however. The European Union ended their quarterly reporting rule in 2013. The United Kingdom followed suit in 2014. Australia and New Zealand have also mandated only semi-annual reporting. And not only have their companies survived, many have thrived. European semiconductor firm ASML is up nearly 1,000% since the change. LVMH, which is the luxury goods company that owns brands like Louis Vuitton, Tiffany, and Christian Dior, they have also benefited from this longer-term approach. Norway's $1.5 trillion sovereign wealth fund has pushed to end quarterly reporting worldwide, saying it creates dangerous short-termism. If the world's smartest investors see the value in less frequent reporting, maybe America should listen. Critics argue that this would give insiders an even bigger advantage. You see, the goal of frequent reporting is to reduce what's known as information asymmetry. This is where one party possesses more information than the other. So, for example, in the used car market, sellers know more about a car's true condition than buyers. That's why we have Carfax reports. So buyers can see the vehicle's service and accident history. Opponents of semi-annual reporting say it would widen the advantage that Wall Street insiders have, giving them an even larger informational edge. Data also suggests that more frequent reporting lowers the cost of capital. Essentially, banks are more willing to lend and to do so at better terms when they have access to fresher, more reliable data. But the fact remains, American investors have become addicted to immediate results. We want to see growth now, yesterday. And as a result, managers are forced to prioritize short-term results, often at the detriment of longer-term success. And while short-term traders like myself often enjoy the benefits of these near-term surprises, they do nothing to help long-term investors. Folks with 401ks and IRAs that are trying to grow over years and decades, not weeks and months. Cutting reporting requirements to twice a year would save companies millions, actually billions, in audit and compliance costs. CEOs would finally be free to build with vision, not just survive quarter to quarter. Investors would also benefit as firms focus on true value creation instead of quarterly games. This reform isn't about less transparency. Material events would still have to be disclosed immediately. It is about cutting the noise, reducing the busy work, and letting American business think bigger. They would also be free to issue more frequent updates should they choose. Despite not being required, many German companies still choose to publish quarterly reports to give more information to investors. American firms, especially those with more volatile sales and earnings, could do the same thing. Quarterly earnings have defined Wall Street for half a century. Betting on that number has become a full-fledged sport. They don't call it earnings season for nothing. But maybe it's time to admit that they're holding us back. Semi-annual reporting could unleash a new era of innovation, efficiency, and long-term growth. And here's how I see it. I always like to take these big picture examples and shrink it down to my life. Forget the $3 trillion companies. Think about your personal life. Forget about buying a $300 billion company. Let's think about buying a $300,000 restaurant. This restaurant is struggling. They're breaking even or maybe losing a little bit of money. You're going to come in, you're going to update the facility. You're going to refresh the menu. You're going to retrain the staff. You're going to put in place processes designed to increase efficiency and lower the drag. That's not going to happen in a month. You are not going to go from losing money to making tons of profits inside of 60 or even 90 days. That's going to take you 6 months, a year, maybe 2 years. If you own a retail business, you are going to see fluctuations quarter to quarter. You're going to see a lot more sales and profits in October, November, December than you are in January, February, March. You always do twice the sales around Christmas. Take an innovative company like Yeti coolers. Yeti had to literally create a market for their products. Igloo and the other big competitors were selling $20, $25, $30 coolers. Yeti comes in and says, I bet I can sell one for $300. They said, well, no, you can't. They created the luxury cooler market. That took time. That took a lot of advertising dollars. That took a lot of R&D. It took a lot of sponsorships. Same thing with something like Red Bull. $3 energy drinks, that was unheard of when they came out. The success and progress of these companies cannot be measured month to month or quarter to quarter. It must be measured biannually, annually, even over multiple years. And the biggest benefit to me would be the possibility of another Cinderella story stock. We've all heard stories of someone who bought Microsoft or Google or Apple 30 years ago at the IPO for $2 a share, and they've made, 100,000%. Those stories don't exist anymore for the most part, and the reason is it's very expensive to be a publicly traded company. Thanks to both these quarterly earnings reports as well as the massive regulations inside of the Sarbanes-Oxley Act, companies just don't IPO. They don't go public as early anymore. Back in the 1980s and even the 90s, when a small but growing company it wants to expand, they'd go out to the free market. They'd go to the American investor to raise money to grow. They issue shares of their company. You can invest if you see their vision, and you're handsomely rewarded when they execute and succeed. But now, when it's going to cost you $100 million a year in audit fees and accountants and filing requirements, you don't go to the public market first. You go to venture capital firms. These guys don't require any of that stuff. They got their own auditors, their own accountants. They'll give you tens or hundreds of millions of dollars, and their goals are very different from the average investor. They don't want to see that company succeed. They want to make a ton of money on the exit. They want to load it up with debt, drive the sales as high as they can, and then dump this bloated monster on the market for you and I, the sucker everyday investor, to buy their garbage inflated IPO, and we're lucky to break even over a 5 to 10 year period while they made 100 times their money. That's the reality of today's equity market. And as long as we continue to grow regulation, reporting requirements, there's never going to be another $2 to $2,000 stock. There's never going to be another Berkshire Hathaway or Google or Amazon. Because by the time these things go public and you and I can invest in them, they're already 10 and 50 and $100 billion. The first 100x move is already gone. But what do you think? Should we break free from this 90-day treadmill to give CEOs the breathing room to actually run their companies? Drop your thoughts in the comments, and I am genuinely interested to see what you think about this. And if you haven't already, hit that subscribe button down there in the corner. That way these videos will show up in your YouTube feed and you won't miss future updates.